Welcome to Finance Made Easy. Bitcoin might be one of the most confusing things in the investment market over the past 2 years. Just a couple of weeks ago, the price of Bitcoin broke through the $20,000 mark, only to crash down nearly half its value in the following days. Many retail investors who recently entered the market are almost in tears. On one hand, China's regulatory stance has become clear, with the government shutting down all Bitcoin exchanges in September this year. On the other hand, many people still believe that Bitcoin will replace traditional currencies and become the universal currency of the future. Does Bitcoin really have a future? This discussion actually revolves around a concept. What exactly are the currencies we hold today? Whether it's the yuan, the dollar, or the pound, what are they? You've probably come across many economics textbooks which define money as a unit of account, a medium of exchange, and a store of value. It seems that Bitcoin satisfies these criteria, but these discussions overlook one crucial thing. The currencies we use are known as fiat currencies, which are issued by a specific bank with the government's authority, and their value is backed by the government's credit. Let's look at a specific example. We all know that the US dollar is at the core of the global monetary system. All international trade must be settled in dollars, and countries issue government bonds in dollars. International commodities like oil, natural gas, and iron ore priced in dollars. But how did the dollar achieve this dominant position? It was established at the Bretton Woods Conference. After World War II, representatives from various countries met in a place called Bretton Woods to discuss a global monetary system. The main point of contention at the conference was which currency should serve as the anchor for the international monetary system. The US and the UK had different views. The UK's representative was the famous economist John Maynard Keynes, who proposed the creation of an international currency unit called the banking note, which would combine the currencies of various countries in a weighted manner. On the other hand, the U.S. representative, Harry White, proposed a system where the dollar would be at the center, pegged to gold, with other currencies pegged to the dollar. Looking back, Keynes' plan was clearly more sophisticated, as it balanced the interests of all nations and allowed for fair trade. White's plan, however, clearly favored the U.S. After 22 days of intense debate, White defeated the renowned Keynes, and the Bretton Woods Conference established the dollar as the central currency, making it the world's de facto reserve currency. Why? Quite simply, the U.S. was just too powerful at that time. Its economy accounted for about a quarter of the world's total GDP, and it held more than 2/3 of the world's gold reserves. European nations, struggling to rebuild after the war, depended heavily on U.S. loans. So, the battle for the status of currency was not about fairness, but about national power. Following the Bretton Woods Conference, the U.S. dollar naturally became the international reserve currency and the core of the global monetary system. In the 1970s, as the economies of various countries began to recover, the dollar came under pressure to depreciate. When the dollar fell, the price of gold surged. Eventually, the U.S. decided to sever the link between the dollar and gold, and the issuance of dollars was no longer restricted by gold reserves. Instead, it was tied to the economic growth and credit of the U.S. By this time, however, the dollar's position as the global currency was already stable. The Federal Reserve had effectively become the invisible central bank of the world. With the decoupling of the dollar from gold, the global monetary system entered an era of fiat currencies, where the value of money is no longer tied to physical commodities, but to national credit. This is how the U.S. dollar became the king of world currencies. From this story, we can deduce a simple principle. Modern money is based on credit, and the value of money fluctuates entirely based on a country's strength and the confidence other countries have in that country. Therefore, a currency without the backing of national credit, even if it can serve as a medium of exchange, store of value, or unit of account, cannot become a universal currency. This logic helps explain many of the confusions we encounter in everyday life. Why has the yuan risen in international status in recent years? Because China's economic strength has grown. Why does the euro fall every time there's instability in the European Union? Because confidence in the EU has dropped. And why did the Japanese yen soar in the 1980s and then start to decline in the 1990s? Ultimately, it's because people's confidence in the country behind the currency fluctuated. The issuance of currency and the national credit behind it is the core and key factor. Actually, there's also a critical player in currency issuance: central banks. Central banks issue money through specific powers granted by the government. This is a key characteristic of modern currencies. Governments and banks are intertwined, shaping the concept of fiat money. This process didn't happen overnight, but gradually evolved through history, with the Bank of England playing an essential role. Looking back at history, we've already seen that Europe had a relatively developed banking system in the 14th and 15th centuries. Many large banks issued promissory notes that circulated in the market as a means of payment and valuation. The concept of banking money became popular in Europe, and banknotes, like the banking note, gradually circulated in the market. At this time, the banknotes issued by different banks were equal in status. There was no bank that dominated others until the 17th century, when the Bank of England emerged. The English monarchy decided to partner with the Bank of England, giving it a unique status. The monarchy granted the Bank of England the exclusive right to issue banknotes for London and its surrounding areas, but on the condition that the bank would provide the monarchy with long-term, stable, and low-cost financing for wars. From then on, the Bank of England's banknotes were officially backed by national credit and became the official currency of Britain. This model of granting a specific bank the exclusive right to issue currency soon showed its advantages. On the one hand, the government could control the issuance of fiat currency, ensuring a stable flow of funds and increasing its power. On the other hand, the government could use currency issuance to control the overall credit scale of society and regulate the economy. Many believe that the Bank of England's monopoly on currency issuance was one of the key factors that allowed Britain to gain an advantage in long-term wars and become a global superpower. I cannot emphasize enough that the intertwined relationship between the state and banks, shaping the concept of fiat money, is crucial to modern currency. The true driving force behind currency is national credit. So, in the current context, where the state remains the most important social institution, if we discuss money without considering national credit, it would be like trying to fish for a tree or abandon the core for the periphery. Now that you understand how the dollar's dominant position was formed and how national credit supported it, and you know how the Bank of England gained its special status to issue money, you can better understand Bitcoin. Bitcoin is a digital encryption technology, and it's clear that it can serve many traditional functions of money, such as valuation, payment, and storage. Digital currencies may be a direction for future currency issuance. However, as long as the concept of the nation remains intact, I believe Bitcoin and other decentralized currencies still have a long way to go before they can replace the fiat currencies issued by central banks. This is Finance Made Easy, helping you gain a higher perspective and re-understand wealth.